Well, let's try and unpack those key signals and what we need to watch for and how to position your portfolio as a result. Grant Mundell joining us from Equity Trustees. Good to see you again.
Hi, Andrew.
I mean, it's difficult to know, isn't it? Because on the one hand, Trump said the war is very close to an end, but then the next, they've just intensified their bombing campaign. So, particularly from a market's point of view, I mean, what do you need to be cognizant of?
Yeah, I think for us, it's really about that key question the markets are looking at is the duration. To your point, that's the key focus for us heading into this conflict. We were already tactically within our diversified portfolios a little bit tactically underweight equities, more so for valuation reasons. And obviously that was because we didn't think there was a margin of safety effectively in equity valuations for adverse events such as this. So we're sort of watching that and retaining that small underweight to equities, but really it's about the duration. Obviously the US and Israel attacking Iran sort of expected this would be a short-term offensive campaign, but obviously the Iranians have been a lot more resolute, pulling in neighbours, destroying energy infrastructure, closing the Straits of Hormuz, replacing the supreme leader quite efficiently. So to us, that means that oil prices are going to, be under pressure between that sort of $80 to $100 per barrel in the short to medium term. Effectively, that's going to have inflationary consequences, and what that is going to mean is that from a sector perspective, you want to be probably a little bit defensively placed in the short term, but it's really about that duration, and I think how quickly the US and Israel decide to, effectively stop the campaign at some point in time.
So how do you separate signals from noise at this point? And is it potentially worth betting on the so-called taco trade and that Trump is going to find an off-ramp?
Yeah, look, I think there's plenty of instances where geopolitical campaigns in the past have ended up being good medium-term buying opportunities. And I think the key thing here is that going into this conflict, the overall macroeconomic backdrop and corporate earnings backdrop was pretty resilient, pretty solid. Higher oil prices are not nearly as sensitive or as negative to the global economy as they once were, and that's through better energy efficiency, substitutes, and also a greater services component of the market. So I think it's going to be those sorts of things that probably mean the markets are okay, and it's really going to then come down to President Trump and the midterm elections as he approaches that, given that gasoline prices are going up, given that this is not a favourable campaign or a popular campaign in the US, means that he's going to probably try and proclaim victory any way he can, but try and shorten that campaign. And that will probably be the catalyst to see markets move higher.
You speak of the macro backdrop. What of central bank policy response in that, certainly here at home, the Reserve Bank certainly the talk about raising rates as soon as next week again. What does the prospect of higher rates, not just here but elsewhere, do just as far as particularly economic growth is concerned, on top of course, you've got that additional impost of higher energy prices?
Yeah, it's a really good point. I mean, that higher oil prices feeding through to higher inflation means essentially that monetary policy, which was really seen as a stimulatory effect to solid economic growth this year, is probably going to lessen. Case in point, the RBA next week is very much a live meeting. The markets are now pricing in 60 basis points worth of hikes this year. Before it was sort of 1 to 2 hikes. So that is going to continue to weigh on the consumer, a little bit more on activity. So things like from a sector perspective within Australian equity portfolios, we've been underweight consumer discretionary, and that would remain the case at this point in time. And similarly for the US, whereby Trump has wanted the Federal Reserve to lower interest rates, the market's now betting it's only going to be 1 rate cut there as opposed to 2, only probably a month or so ago.
Right, and that's certainly going to annoy President Trump. Isn't another reason perhaps he's not going to find an off-ramp as soon as he can. So, Grant, just in terms of what you do with your portfolio then, do you need to take a more defensive stance?
Well, I think, as I sort of said, tactically we were slightly underweight equities. We've been a little bit overweight defensive assets or defensive sectors, shall we say, within our Australian equity portfolios, things like telecommunications, healthcare and staples, and underweight things like consumer discretionary. To the other point, we've actually neutralised the underweight that we had in energy. So we think that in the short term, we want to be a little more defensively placed, but really at the end of the day, you want to hold true to your investment strategy. Markets are obviously very volatile, and trying to predict or time markets is very, very hard. So if you're trying to be a bit too quick and a bit too nimble, you can miss out on the really strong bouncing back days. So I think you want to be aware of that. Also, I think, if you're looking at quality securities or quality assets, which we typically try to, the underlying earnings, cash flow and dividends coming through from those securities is much less volatile than the headline indices or stock prices. So over a medium term, effectively the stock price will revert back to those underlying cash flows, and that will sort of see stock prices start to recover.
All right, so largely defensive, you're looking for those quality companies. Can you give us an example of what you're looking at the moment?
Yeah, I think one example within an Australian equity context is Coles Group. We think that ticks a lot of the quality boxes that we like to look at when we're looking at different stocks and securities. It is a company that is well managed. Operational performance has been very strong, and that's been shown throughout results over the last 12 to 18 months. It's invested a lot in terms of infrastructure, so the returns are improving. The earnings growth is looking at double digits, so that's strong. The balance sheet is pristine. Dividends are growing and nearly 4% fully franked. And valuation is now quite compelling when we look at it relative to the market and also relative to Woolworths, its closest peer. So we think that one, give good defensive earnings stream, good industry structure, good pricing power, market leader with good competitive advantages is well placed in a portfolio.
A little more broadly, obviously the two sectors that dominate materials and the banks, are you adjusting in those two, particularly given the dominance of, well, I guess the big five, the big four banks and BHP, for instance?
Yeah, I mean, they were stellar performers during the course of February, where we saw really CBA and BHP up 17 to 18% on the back of very strong results. At the moment, look, we'd say that yes, we're slightly underweight the banks, and that's really more so because we're underweight CBA or Commonwealth Bank from a valuation perspective. But if you look at the fundamentals, they're pretty sound. Credit growth has been reasonably strong. There is leverage to some of those increasing rates at the moment. Bad debts have been low. They're well capitalised. So certainly, fundamentally they're looking pretty sound. It's just a valuation argument for us for Commonwealth Bank. And from a resources perspective, we're broadly neutral, but we're mainly playing that through the big diversified players and companies with exposure to copper and aluminium, which are our preferred base metals.